Hi everyone, welcome back to Corporate Decoder, the place where we dig through the documents so you don't have to. Today, we're diving into Duos Technologies' latest quarterly report. And trust me, it's a bit of a roller coaster. It's got big revenue swings, a few related party head scratches, and an interesting bet on energy that could either be genius or, well, let's just say it'll keep things interesting. First, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below, so you can discuss the numbers and their implications with other decoders. So what's this report all about? It's their 10Q, which is basically a quarterly checkup for publicly traded companies. It tells us how they're doing financially over the last 3 months. This one's for the period ending March 31, 2025. Duos has about 11.6 million shares of common stock floating around as of May 9, 2025. Keep that number in mind. It helps put things in perspective when we talk about per share earnings, or in this case, losses. Alright, let's dive into the financials. Buckle up, because this is where the story really starts to unfold. First up, the balance sheet. Their current assets, things they can quickly turn into cash, are sitting at $7.4 million. That's a bit lower than the $8 million they had at the end of last year. We'll want to see how that trend goes. Their property and equipment, that's the value of their physical assets after depreciation, comes in at $3.3 million, notably up from $2.7 million at the end of 2024. This could be a signal of continued investing in their business. On the other side, they have $13.9 million in current liabilities, which are debts due within the next year. That's down from $16 million at the end of the previous year. Now here's a key number. Accumulated deficit is a scary $76.4 million. This shows their losses over time, and that is quite high. They had an accumulated deficit of $74.3 million at the end of last year, which means that number got worse. Now let's look at the total value of the company. The total stockholders' equity is just above $5 million. That's an increase compared to the end of last year with just above $2 million. Let's move to the income statement, the report card on how well they'd made money this last quarter. Their total revenue for the quarter was about $4.9 million. That's a huge jump, around 363% compared to the $1 million they pulled in during the same period last year. That jump seems impressive, right? We'll see where that revenue came from in a bit. But it also cost them $3.6 revenues. That's a cost of revenue increase of about 273% year over year. After taking expenses into account, Duos had a loss from operations of about $1.7 million. It doesn't look too good at first glance, but that loss is less than the $2.7 million loss from operations in the same period last year. This shows that it's better than before, but it's still not making profit. The loss per share comes to $0.118, which is better than the loss per share of $0.38 last year. The cash flow statement tells where the cash comes and goes. They burned approximately $4.6 million in operating activities, which is not good. This means cash is flowing out the door from main business operations. The comparative number was $2 million. They used $581,000 in investing activities, and that number was comparatively negligible last year. Luckily, they have a net cash from financing activities, mostly from issuing stock of $2.7 million. So let's step back to look at the total liquidity of the company. This led to an ending cash balance of $3.7 million. What does Duos actually do? Well, they're in the business of analyzing moving objects using machine vision and AI. Think trains, trucks, even aircraft. The hope is to improve safety and maintenance with all this tech wizardry. Checking for any legal issues is important, but in this case, there aren't any alarming legal issues that they think would hurt the company. Now that we've covered the numbers, let's shift gears and talk about some big changes happening at Duos. They're not just a rail inspection company anymore. They are rapidly diversifying. Duos is branching out. They have developed new subsidiaries, Duos Age AI and Duos Energy Corporation. These new lines of business are focused on edge data centers and power generation outside of traditional utilities. Duos management believes that it would be in the best interest of the company and its shareholders to expand into these markets. Also, Duos Energy is tied in with a Fortress Investment Group entity called Sawgrass to manage power generation assets. Our CEO was the former CEO of Appia Energy, so he has a good background in this new role for the company. Also, it's worth pointing out where their revenue is coming from, as in the dependency they have on a small number of specific customers. In fact, 3 customers make up 60% of the total revenue. That's quite a big number for just 3 customers. Okay, let's change gears to talk about the stock. During this quarter, they converted Series D preferred stocks to common stocks. This involves exchanging previously issued preferred stock for common stock on the market. Let's discuss the operating lease obligations. Under the operating leases, one of which is for the company headquarters and warehouse space, the company pays approximately $200,000 a quarter. Looking at more recent events since the close of the quarter, they made a change to their stock sales agreement, which allows them to sell additional shares on the market. Finally, the report stated that there were no changes made to their trading plan. This is an official legal and company confirmation that there's no insider trading going on, so that's good. Lastly, we have the signatures of the Chief Executive Officer, Charles P. Ferry, and the Chief Financial Officer, Adrian G. Goldfarb, which means that they agree with the report, so it should be true and well presented. Alright, that was quite the roller coaster ride through Duos Technologies' latest filing. It's tough to ignore those numbers. They appear very rough with low levels of cash and continuous losses. Let's try and see the big picture here. The significant increase in revenue is almost entirely from the high-margin management services, with Fortress, which is clearly helping drive overall improvements. We are glad to see that happen after that large investment has been made. The diversification strategy could be a game changer if they can execute well. Edge computing and power solutions are hot markets and could potentially stabilize and increase revenue. What's most important is the AMA partnership with Fortress. What happens if that falls apart with 3/4 of the company's revenue walking out the door? That can be devastating. This is going to depend heavily on how this new business and relationship turns out with Execution, and without it, I simply cannot give this a positive rating. Alright, that's our breakdown of Duos Technologies' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.